Right then, good afternoon everyone, and we are at the end of another week of trading, the end of the first week of a brand new year. Happy New Year, Happy New Year to anyone listening from all of us here at the London Academy of Trading, and we are getting stuck into another year of trading. Um, we look across the calendar, with a quick look across the calendar, not a great deal of information we can actually work with in terms of trading until we've come to today, where we've had some pretty aggressive moves across a number of different markets, across a number of different asset classes. Throughout the week, we had a few data points. You see the manufacturing PMI at 3 o'clock on Wednesday out of the US. Uh, so again, another slow manufacturing print, a weak manufacturing print that has been trending lower for quite some time and does not point towards healthy signs of an economy going forward. And that was the financial news sources. That was the news flow heading into this week, first year of trading, first week of a new year trading. Sorry. It was all about a recession, all about a global recession. How bad's it going to be? How deep's it going to be? Recession in the US, in the Eurozone, in the UK, and in many countries across the world, contributing to a global economic slowdown in the midst of all of these interest rate hikes in order to control inflation, which is obviously at an unacceptable level. So no matter where you look, inflation is high. You can see German inflation on Tuesday pulling back. Are pulling back. We'll get on to inflation a little bit later on, but inflation in Germany pulling back, slowing down. Inflation in France slowing down. We got inflation in Italy also slowing down over the course of this week. So making progress, definitely signs of progress. Certainly in the US as well. We've got a couple of negative prints, a couple of weaker prints in terms of the core CPI print as well. So a bit of positivity surrounding that, but we'll head into the US CPI print next week, which we will get back to in a minute. It brings us on forward to today. Non-farm payrolls, NFP day, the first Friday of the month, first NFP of a new day, of a new year, and slightly positive figures in terms of the consensus, or above consensus. It is the lowest NFP print since December 2020, the least amount of jobs added over the course of a month since December of 2020. The unemployment rate did tick down as well, previous 3.6 back down to 3.5 when markets were expecting a print of 3.7. So slight bit of positivity around that. In terms of how to read into it, it might be a little bit tricky. I mean, talk about average hourly earnings. Wage growth is slowing down as well. So with wage growth slowing down, that is needed in order to cool down inflation as well, which markets can see as a bit of a positive. You could also spin it on the fact that unemployment rate remains low, the job market remains strong, and as long as that unemployment rate can remain as low as it is, the longer it can remain as long as it is, the shallower a recession may be in the respective nation. So there's a bit of positivity then surrounding that. Not much else to be positive in terms of the manufacturing prints and the non-manufacturing prints, and especially weak non-manufacturing PMI we just had about an hour ago now at this point. So we'll flick across to some markets. We'll have a quick flick across some markets, and you can see a bit of positivity up the right hand side. Up 1.4 at the time of speaking on the S&P. The Nasdaq, sorry, up 1.3. The Dow Jones up 1.5. You can see dollar weakness across the board on the right hand side. But if you just have a quick flick across the stock indexes, I mean, you can see this is a daily chart. We can see we're quite clearly still in a pretty clear range that we've had since before Christmas. Look up towards the Nasdaq, we're still trapped in that range, and across the Dow Jones, we're trapped on that range as well. So although we've had some positivity across stocks, we are still trapped within these ranges, and we are testing the upper bands of these ranges. If we can get a breakout, hopefully there's a bit of upside. There is a bit of room on the upside, certainly in terms of technical levels across the three of these indexes. You might see it up towards 4,100. Good, what's that? Good 200 handles higher if you can break through 3,900 on the S&P. So that would be one that's interesting to watch as we head into the close. Do they remain in these ranges, or do we get a pop out through the course of the remainder of this US session? Obviously, we'll have to take a bit of time to see how that plays out, but definitely a bit of positivity across stock indexes, which then drags the dollar lower across the board in reaction to the NFP, in reaction to the unemployment rate. So whatever way you try and spin it, that is the reaction. Which is long stocks and short dollars. Now that does play into a bit of a thinking into next week. have a quick look as we get into next week. You can see then we've got CPI on Thursday out of the US. We're expecting again a further decrease in the core CPI print, which is really the main one we need to watch. The CPI print, the total rate of inflation, is pulling down quite substantially. This core CPI print, if we can get this below consensus, down to 5.5 or something, that will be, you will see a good bounce in stocks and a bit of a further pullback in the dollar. Long stocks and short dollars seem a good trade into that if that does play out. If it comes in a little higher than anticipated, higher than the consensus, well, then we'll have to kind of cross that bridge when it comes to it and see how the reaction to that is post-release. But I think from now, certainly judging off the reaction to NFP, whatever way you try and spin it in your own head, the reaction has been long stock, short dollars. And into CPI next week, that is probably the reaction you would hope for. A weak CPI print, long stocks and short dollars. So those two things can go aligned. We can get these fundamentals helping us push us in the right in that direction. That can create some trading opportunities for us. But how long that lasts really is anyone's guess. I mean, a global economic recession is not an environment that stocks flourish in. It is not an environment that the US dollar does poorly in. Normally that's an environment that the US dollar increases in value and people buy US dollars as the safe haven of choice when expecting a global economic recession. So we'll have to see how that plays out into next week. I think long stocks and short dollars seem a decent bet in terms of, if you have to trade it. That's certainly how I'll be looking at heading into next week. Once we get the close today, especially if we can break out some of these ranges on stocks, that'd be pretty positive. But if this positivity remains in markets over the course of the rest of today, certainly on Monday, that can open us up with some fresh opportunities to jump back into some long stock positions. But we'll cross that bridge on Monday morning when we get to it. GDP figures out of the UK as well on Friday of next week. Consensus is for minus 0.3. We did not get the negative print in October, so if we can remain at zero or remain slightly positive in the November print, that will be 2 out of the 3 months that's not weak, and you might see a bit of a short-term bounce on sterling. Off the back of that, the Bank of England were predicting a recession in the fourth quarter of not this year, fourth quarter of last year, sorry, and then the entire duration of this year. If you can avoid that in Q4 of last year in terms of the technicalities around it with negative growth, maybe that provides a short-term bit of support for sterling. So we'll keep our eyes on that as well as we come around to it next week. But that's it from me then, folks. I'll let you get on with your weekends. Do have a good weekend. Do get some rest and relaxation in them. It's been a long first week back, certainly for us. I'd imagine most people, after a couple of weeks off after Christmas, will be feeling the same. A little bit difficult to jump straight back into markets and go bang, bang, bang looking for trades. Once you get your eyes back in, you start to get used to what you're doing again. Next week will become a little bit easier. So this week's not gone great. Don't worry. As always, there's 51 weeks of the year left, so there's a few more opportunities to make money as we go along through 2023. That is it from me then, folks. I'm going to wrap it up there. Keep an eye on, keep an eye on US related assets. Keep an eye on stock indexes. Keep an eye on the US dollar. We'll cross that bridge when it comes to it next week in regards to CPI. Maybe just before I go, actually, maybe just we did have the Japanese. If you're looking for short dollars, I think the Japanese yen is probably the best to pair with. Looking for short dollar yen, which would be Japanese yen strength. Sorry, we did have a slight change in monetary policy out of the Bank of Japan just before Christmas. They raised the band on the upper band of their 10-year yield, the cap on their 10-year yield up to 0.5%. That is a hawkish step from the Japanese, and I think if you're looking for short dollar yen's the way to play it. Long stocks, you could play any of them. The S&P is obviously the most widely traded, so maybe you could have a look at that one. But yeah, maybe short dollar yen and long stocks seems the way to play it. For now, obviously things can change pretty quickly, but obviously we will cross that bridge when it comes to it. Actually, I'm going to wrap it up there then. Have a good weekend, folks, and I will be back next week for another weekly market insights. Thank you.